At some point in the last few decades, something strange happened. Money stopped coming from printers. At least, not in the way most people imagine. There are still presses. There's still ink. But if you think money today is created by governments physically printing cash, you're already behind the story. Because the uncomfortable truth is this: almost all money you use was never printed at all. So the real question isn't who prints money? It's who controls it now? And the answer is quieter, more boring, and far more powerful than most people realize. Let's start with a simple image. Picture the last time you used cash. Notes, coins, something you can hold. That physical cash. In most countries, it makes up less than 10% of all money in existence. Sometimes much less. Everything else? Numbers on screens. Balances in apps. Entries in databases. Money that exists only because someone agreed it does. Which immediately raises a disturbing question. If money is mostly digital, if it's not printed, who decides when it appears? And who decides who gets it first? Because whoever controls that controls the economy. Now, the usual answer people give is the government or the central bank. That answer is half true and half misleading. Central banks do play a role, a big one, but they're not the ones creating most money anymore. Commercial banks are. And once you see how that works, the system feels very different. Let's rewind. Originally, banks did something simple. They stored your money. If you deposited $100, the bank held $100. Boring. Safe. Limited. Then came the realization that changed everything. Most people don't withdraw their money at the same time. So banks started lending some of it out. If you deposited 100, the bank might lend 90 to someone else. That borrower spends it. That money gets deposited again. And now the system shows $190. No new cash. No printing. Just accounting. That was the early version. But modern banking took this much further. Today, when a bank gives out a loan, it doesn't move existing money. Creates new money. Yes, literally. When you take a loan for a car, a house, or a business, the bank types numbers into your account. Those numbers did not exist before. They are not transferred from someone else. They are created at the moment of lending. This isn't a conspiracy theory. It's documented. Central banks openly explain it. Loans create deposits, not the other way around. Which means most money exists because someone somewhere took on debt. Pause on that. Your salary, your savings, your investments. They're connected directly or indirectly to someone else's loan. Money is no longer backed by gold. It's backed by promises to repay. And now we arrive at the real control mechanism. If money is created through lending, then whoever decides who gets loans, decides who gets money. That power sits largely with commercial banks. Not elected, not voted on, quiet. Banks decide which businesses expand, which housing markets boom, which ideas get funded, which ones die quietly. They don't need bad intentions. They just need incentives. And their incentive is simple. Lend where returns are highest and risk is lowest. Which sounds reasonable, until you zoom out. Because it means money flows toward people who already have assets, already have collateral, already have stability, and away from those who don't. This is one reason wealth concentrates over time. Not because of secret meetings, but because of how money is created. Now, where does the central bank fit into this? The central bank doesn't usually create money for everyday spending. Creates conditions. Think of it like a thermostat. It doesn't decide where heat goes. It decides how easy it is to turn the heat on. Interest rates. Reserve requirements. Liquidity facilities. When central banks lower interest rates, borrowing becomes cheaper. Banks lend more. Money supply expands. When rates rise, lending slows. Money creation contracts. So the central bank controls the speed of money creation. But commercial banks control the direction. That distinction matters a lot, because during crises we see who really has access. Take 2008. When the system nearly collapsed, trillions were created. Not printed. Created digitally. But that money didn't go to households first. It went to banks, financial institutions, asset markets. Result? Stock markets recovered faster than wages. Housing prices rebounded faster than incomes. Same thing during the pandemic. New money flooded the system, but where it landed first shaped who benefited most. This is why people say money printing causes inflation and feel confused when prices don't immediately explode. Because inflation depends on where the money goes. If it flows into assets, you get asset inflation. Stocks, real estate, crypto. If it flows into everyday spending, you get price inflation. Same creation, different impact. And now we arrive at the modern myth. The idea that money is neutral, that it's just a tool. It's not. Money creation is power. The power to decide what grows, what shrinks, what survives. And this power is exercised quietly through credit decisions, balance sheets, and interest rates, not speeches or laws. Now layer on something even more unsettling. Most of this system runs on confidence. Banks create money because they believe loans will be repaid. Borrowers take loans because they believe future income will exist. Markets function because everyone believes numbers on screens are real enough to matter. Nothing collapses faster than belief. That's why central banks care so much about expectations. Why they signal. Why they speak carefully. They're not just managing money. They're managing trust. Because if people stop believing deposits are safe, if banks stop believing borrowers can pay, money creation freezes, and the economy stalls. So who controls money if no one prints it anymore? Not one person, not one institution. It's a layered system. Central banks set the environment. Commercial banks create most money through debt. Markets decide where confidence flows. Governments react, usually late. And ordinary people, they participate, but rarely control, which leads to the uncomfortable implication. We live in a system where money is created as debt, controlled indirectly, and distributed unevenly by design, not malice. It works remarkably well until it doesn't. And when it breaks, the fixes tend to protect the system first and people second. So the real question isn't whether this system is evil or good. It's whether it's stable. Because when money isn't printed, when it's typed into existence, the real limit isn't paper or ink. It's trust. And the moment enough people question who controls it, the entire system starts to feel very fragile. So next time you look at your bank balance, here's the unsettling thought to sit with, that money exists because someone, somewhere, owes someone else. And the people who decide whose promises matter most quietly shape the future. Who should control that power? And what happens if confidence finally runs out?